This podcast channel is about you, successful international entrepreneurs, successful expats, successful investors. Sponsored by HCJ.tax.
Okay, and it's 5 o'clock, so we're ready to begin. Thank you for coming or logging in this afternoon to hear our short webinar about US Singapore tax. My name is Derren Joseph, and joining me are my colleagues Boon Yip and Eddie. Yeah, down below anyway. Just a reminder that we are recording and we are live streaming this. So what that means is that if you do not want your image to be recorded, then you will switch off your cameras, and that's what it is. So it is being live streamed right now on Facebook and on LinkedIn and on YouTube. If you have any questions, so the way we're going to do this is the way we do all our webinars. So for those who've joined us before, you'll be familiar with the format. I'm going to speak for 15 to 20 minutes on US taxes. Boon Yip and Eddie are going to talk for 15 to 20 minutes on Singapore taxes, which leaves us with 15 to 20 minutes for Q&A. So you don't need to wait until the end if you have questions. There's a chat box down below. You just type in whatever questions you may have. Bear in mind, if you have to leave or you get kicked out or you've experienced some sort of disruption, it will be available on our website, hcj.tax. Once everything is finished and it's edited and whatever. So without further ado, I am going to share my screen and we're good. All right, great. So as I mentioned before, my name is Derren Joseph. I run a semi-autonomous tax team within a larger practice called Moores Rowland. Moores Rowland Asia Pacific, we have just over 30 offices in, I think it's 13 countries now, so as far north as Tokyo and Beijing, all the way down to Australia. I actually sit in Singapore. I've been based in Singapore for the past 8 years. Well, October will be 8 years, so I'm kind of cheating a bit. This is me, this is my bio. So it's important that you know why I feel as if I'm confident and competent to speak about this topic. Now, because of US rules, I'm legally required to say that treat this as an education piece. I know we got some questions in advance. I know some of you are self-filers, and I just want to correct any misconceptions. This is not a webinar where you can come with pen and paper and at the end you're confident and competent enough to go away and do your returns. What the takeaway from this should be would be, these are the key points that you need to keep in mind as you engage a qualified advisor to help you on both the Singapore and the US side. So again, this is not advice. This is not advice. This is not advice. This is an education piece, and you will have takeaways to engage with a competent advisor. Nothing I say here, nothing that we say here should be construed as encouraging you to pay less than your fair share of taxes in any jurisdiction in which you're exposed. And that's how we stay out of jail. So for those who doubt the long reach of the IRS, there are two case studies that we can circle back to if it comes up in the Q&A. One of them actually used to be my friend on, well, not friend, but one of my connections on Facebook. And he's no longer on Facebook. Why? Because of the long reach of the IRS. He had some legal problems and he had to spend some time in jail. So my point is this: there's some people that think, I'm outside of the US, nobody's gonna bother me. That is so far from the truth. The IRS does pay special attention to those US taxpayers outside of the US. Now, just to quickly jump into everything, citizenship-based taxation. I don't think I should need to say, I think everyone would be already familiar with the reality that as a US citizen, as a US green card holder, you are subject to taxes on your worldwide income. Now, other jurisdictions do tax on your worldwide income. It's pretty common. with advanced economies, so your OECD nations, so Canada, Australia, New Zealand, UK, Europe, Japan. But I think what makes the US unique is that even though you spend many years in Singapore, and even though you spend many years outside of the US, you are still tax resident in the US. You're still required to file and pay taxes. It just doesn't go away. It just doesn't go away. There are many misunderstandings about this, but it just doesn't go away. Then people ask, well, how do they know what I do outside of the US? And this is where FATCA comes in, the Financial Account Tax Compliance Act. Now, when you're in the US, you get paid on a W-2. If you have investments, you get a 1099. A copy comes to you and a copy goes to the IRS. So they're checks and balances. So if you say something different from what the IRS has already received, they're gonna know. Of course, when you're outside of the US, you ask yourself the question, well, how are they gonna know? And FATCA is the answer. So what that piece of legislation has done is empowered financial institutions around the world to basically act as a tax agent. So OCBC, UOB, all these banks that you would find in Singapore are required, because of FATCA rules, to identify who among their account holders may be US exposed and report their bank activity to the IRS. Now, like me, I'm sure you have more than one passport. And so you may think, you know what, I'm smart, right? So I'm going to use my other passport to open that bank account at OCBC or whatever, or POSB. And then you think, okay, so who's going to know? Well, there's certain rules that are enshrined in the legislation here in Singapore and are also reflected in the bank policy. So even though an account, the account holder represents him or herself as being another citizen, if that bank officer has any reason to suspect there's certain indices or signs, if they have any reason to suspect a US connection, they are legally required to report you still without your knowledge to the IRS. And you will be highlighted as potentially as a recalcitrant account holder. There's a special designation for those people who are in denial. So in other words, it comes back to bite you. And that creates the checks and balances. So if it is that you said that you made $100 this year, yet your bank balance goes up many times that, then it creates an exception in the reporting back at the IRS or in Treasury, and they can come and ask you questions. So what do I mean by US person? So of course, US passports. Now for those, and this has been a big deal for those who were affected by COVID and the travel disruptions, we had cases of many Singaporeans who, because of travel disruptions, no fault of their own, they were stranded in the US. And they triggered what we call substantial presence. So by spending a certain amount of time in the US, under Section 7701, you will be considered a US person as if you were a citizen or a green card holder. So substantial presence is one way in which you trigger that US tax exposure. Another way is accidental Americans, and it happens all the time. American citizen comes out to Singapore, Malaysia, Indonesia, and they get married or have a relationship with someone who is not American. And the child of that union sometimes may be an accidental American. So even though you did not register at birth at the embassy, even though there's no social or passport, that Singaporean child is also a US citizen, until it's renounced officially. And at some point in time, they may be required to file and pay taxes when they work. Another way in which you may become a US person is intentionally under Section 6013G. And we can get into that in the Q&A if there's any questions around that. But basically, you can elect to have your non-American spouse, your Singaporean spouse, to be treated as a US person. There's certain tax advantages, or it may be of strategic importance if it is you intend to move to the US at some point in time. So the responsibilities of US persons are pretty straightforward. I think what strikes some people as somewhat counterintuitive is the idea that, okay, if I'm in the US, so if I don't file and pay my taxes, then, you know, it's interest rate, a zero interest rate environment anyways, so it's not going to be that much depending on what your liability may be. But when it comes to international tax, counterintuitively, the IRS spends more time focused on reporting than they do in actually paying. What do I mean by that? So again, if you don't pay interest, but if it is that you don't report that bank account at UOB, the penalty could be up to 50% of the unreported balance. If it is that you don't report your investment in a company in Singapore, just again, it's not necessarily a tax liability. It's just that you did not report your holding in that company above whatever the threshold may be. Your penalty could be $10,000 per year. So, and we have had cases where the IRS has, you know, enthusiastically levied those penalties for US persons in Singapore and Malaysia who have not been compliant. So remember, it's not, you know, we tend to be focused on, yeah, we need to pay our taxes, but it's reporting all transactions. And these reports may not necessarily trigger tax liability, but post 9/11, starting with the Patriot Act, there's been a certain aggressiveness when it comes to pursuing people who are not reporting their activities outside, and that can include gifts as well. You know, you have a relationship, you're married to a Singaporean, and there may be gifts going back and forth. Those gifts are reportable above a certain threshold, and again, failure to report maybe up to 30% of the gift. So again, it's not necessarily a tax liability being triggered, but it's a reporting requirement to be taken seriously. So what we've devised, or what I've devised, is what I think is a nice acronym for remembering what your responsibilities are as an expat, as a US exposed person in Singapore. And that is, I ask you to do your best. What do I mean by do your best? B stands for bank accounts. And by bank accounts, I also mean all financial accounts. Whether some people invest in iFast, some people have a CPF because they're PR, whatever the case may be, or you may be Singaporean with a green card. Every financial account, unit trust, every financial account that you have, brokerage accounts, they need to be reported. Again, it may not trigger a tax liability, but the IRS wants to know where your money goes. Next, estimated taxes. Obviously, when you're in the US, you get paid on a W-2. And there's withholding every 2 weeks, every month, as the case may be. When you're outside, well, you know, there's no withholding typically. So that means the responsibility falls on your shoulders. You need to work out so we're in 2021 right now, what is your estimated tax liability for 2021? And make sure that you pay in at least 4 installments, so quarterly payments. Failure to do that, you know, there's a Form 2210 and a penalty may be levied. I had a client just today saying, hey, what's going on? Why am I facing this penalty? What's this about? Unfortunately, you did not make your estimated tax payments in 2020. I know a lot was going on, but the IRS wants its money, and they don't want to wait until April 15th of 2021 to get taxes paid on what you earned in 2020. You should have been paying it in quarterly installments. Thirdly, your state taxes. Do your best. BES. S stands for state. You have 50 states, 50 different rules. But most states are domicile states. What do I mean by that? Unless you were proactive and you re-domiciled to one of those 9 states without an income tax, there are cases where you have lived in Singapore and you're still subject to state taxes back in the US. And you may think, well, I'm in Singapore. What are they going to do? Come find me? Maybe not. But at some point in time, you may return to the US and you get faced with you're greeted with a big fat tax bill. And we've seen it so often, I can't tell you how often we see it. So you need to work with your advisors to ensure that you're properly severed your tax resident with your state of origin before, the state that you were last domiciled at before moving to Singapore. Last but not least would be transfer taxes. And these are a bit tricky because the rest of the rules, you can Google, you can see them in the US, in the tax code, in the Inland Revenue Code, IRC. But when it comes to transfer taxes, we have to rely on case law. So it's trickier to track down and to understand and grasp, especially when it comes to the concept of domicile. It isn't defined in codes. We rely on precedents. But anyway, the bottom line is that if you're gifting back and forth to friends, to people with whom you have some sort of relationship, any transfer taxes, please bear in mind that there may be a tax responsibility, a reporting requirement. I'm not talking about like a tax bill to be paid, but at least a report to be filed as part of your tax return. So transfer taxes, pay attention to that. And of course, we live in unprecedented times. So estate planning is also something that we strongly advise. So again, seek out a qualified estate planner to help you with that, because again, unfortunately, we have a part of our practice which is dealing with Singaporean spouses who've lost their US spouse, and they've left this Singaporean widower with a lot of unfinished business when it comes to the tax side. There was no proper planning, and there's distress in the family. I'm sorry to speak on such a morbid topic, but it creates distress in the family when there's the cash flow interruptions, because sometimes you cannot access, especially US cited assets like US brokerage accounts and stuff like that, until certain paperwork is done. But that inconvenience, we can preclude it by proper tax planning. So I'll leave it there. I'm going to talk a bit about stimulus payments because, some people have questions around that. So we're in our third round of stimulus payments as of last week, I guess. Now, the first two rounds, the first round was around last summer, and then the second round was in December. These are the criteria. So everyone, even green card holders, could qualify for those stimulus payments. Let's see. Right. If it is, you didn't get it, because I know a lot of you have reached out and said, hey, I did not get my check. It was not deposited to my bank account. What do I do? It's not too late. It's okay. When you're working with your tax team to file your 2020 returns, there's something called a recovery rebate, which means that if it is you have a tax liability, it can be reduced by the amount of the stimulus payments, even though you didn't get it, so you get a credit. Or if you do a refund, the refund will be increased by the amount of the rebate credit. So it's still available. Speak to your tax advisors on that. Many of our clients are high income earners, and of course they see, they're following the news. They know, hey, checks have been issued. Where's my money? So I get emails and WhatsApps. Derren, what's my money? I'm not getting my money. Unfortunately, it's targeted at lower income earners. So many of our Singaporean clients, they phase out. So when you make beyond a certain amount, unfortunately, it's reduced until it's nothing. So if it is you didn't get it, one of the possibilities is that, it's a price of your success. You earn more than, the allowed limit. And then, of course, right now we're in, phase of stimulus payment round 3. Those some clients have already got it. So we always encourage people to e-file. E-file is, especially right now, you have no clue how much of a mess the IRS is in right now. How many people paper filed returns to 2019 and they have not yet been processed. I know it's crazy, but when COVID hit last year, the IRS shut down its offices. And then when they did reopen, they reopened social distancing. So it wasn't at full capacity. and the mail system has been a complete disaster. So returns have been lost. You know, things just have not been processed. You're spending hours on the phone trying to get through. So please e-file. Even if you have a Singaporean spouse, you can get an ITIN, which is the equivalent of a FIN, a foreign identification tax ID, for someone who's not a US person. And our software actually allows us to e-file returns even if your Singaporean spouse does not have an ITIN. So the point is that when you e-file, you get these payments. First of all, your returns get processed on time. And if you do a stimulus payment, it comes like that. So people have got them because they have been e-filing. So they've got even number 3 already. So again, remember, this is going to be higher than the other 2, but it does phase out. So bad news. Again, to be fair, most of our clients won't get a stimulus payment under round 3 because of the phase out rules. The IRS has, to their credit, even though, you know, I've come down hard on them for what's going on in the processing side, the website is up to date. So you can check out irs.gov and you can track your payments. There's a comprehensive FAQ. So please check it out. Everything is there. I also, you know, this is my final slide, I think. In terms of filing requirements, there's a misconception. You know, sometimes people think, you know, if I earn less than the foreign earned income exclusion, hey, I don't need to file a return. Not exactly. The threshold the filing threshold changes year on year. And this year, it's actually for 2020, it could be as low as $5. So if you married filing separately, if you earn more than $5, a return is due. So again, don't assume because you didn't earn a certain amount that a return is not due. In fact, assume the opposite. Exercise, you know, due care, exercise diligence, and try to figure out, speak with an advisor, make sure that you're filing whatever it is you're required to file, because the thresholds are pretty low. I wanted to, sorry, there's one more slide. President Biden, the press over his proposed tax plan. We can probably jump into that later, but it's just a plan. And I know the media has been hyping it up over the past 48 hours, but it's simply what his campaign had published. His campaign published last year a comprehensive, it was pretty detailed. But just to call out the highlights that may be relevant to expats in Singapore. For those earning over 400K, the cap on Social Security may be removed. So there's going to be an extra 12.4% potentially. And again, these are just proposals. Everything has to be debated, of course, in Congress. Corporate income tax for those who are working with structures, especially those who own businesses here in Singapore, know what the GILTI tax is. Sorry about that. But the corporate tax is going to go up proposed to go up from 21 to 28, which has implications for both your US structure and your Singapore structure. Child tax credits, good stuff. This step up in basis that you get for those who are planning for succession and estate planning, you get a step up in basis in your assets. Especially if you have a grant or trust, that's going to be removed. The exemption for gift and estate taxes, President Trump had it at just about 11 million. It's going to come back down to around 3 million. So that's going to bring a lot more people into the tax net. So those are just some of the highlights, but of course, everything is just tentative and subject to further discussion. And with that, I will stop here and I will turn you over to Boon Yip and to Eddie, who will walk you through the Singapore side of things. Boon Yip, over to you. Are you, Boon Yip, are you okay? Are you able to, yeah, you should be able to unmute yourself, yeah. Yeah.
Oh, okay. Yeah, I missed the early part. My name is Boon Yip, so I'm a director of SME client service, and with me is Eddie, and he's our tax director, specializes in Singapore taxes. So let me share my screen. So today we will be covering Singapore budgets, just a highlight and a summary of the changes in tax. So as you can see, the Singapore budgets 2021 basically talk about emerging stronger together. So the supports are mostly channeled to the families and household, and those lower income families. And there are some, of course, to the business. Okay. So before I go further, so Eddie would actually take on the Singapore budgets updates, and I'll tell you more, just a brief about Singapore. So I believe some of you maybe already in Singapore, so you would have know. And Singapore actually is unique by all this diagram. If you can see, competitive global economies, ease of doing business, to name a few. So we actually rank quite high, and being a popular place for businesses and also individuals. Okay, so the incorporation. So when you come to Singapore, it's quite easy to get things started. So basically, these are the process, and it could take just a week, and everything is up and going. Okay. Okay. Briefly, taxes in Singapore. So corporate tax, if you can see, is quite attractive. One of the lowest tax regime in the region. So you're talking about 3% effective tax rate. These are YA 2020, but I don't think YA 2021 it will be much changes. So there are basically two tax calendar for companies. Taxable. So if you look at all these points, these are all taxables. The gains and profits from trade and business, income from investment, interest, of course, royalties, and gains in revenue in nature. So other than this, they are all non-taxable. Individual rates, we are on a progressive system. So individual tax calendar is the 15th of April every year. So it's about time to file our personal tax. So it's very about 1 month from, 2 months. Yeah. So again, taxes for individuals. So whatever is taxable, they are quite similar to those of corporations. So we talk about employment income, trade and business for sole proprietors and partnerships, of course, property or investments, and other source of incomes. So whatever is non-taxable, can see, okay, if you talk about interest, it's actually not taxable under individuals. For companies, it's taxable. So I can see this is the only major difference between the individuals and the corporate, right? Okay, just to brief you, Singapore is one of the highly incentivized countries. So these are the selective incentive in Singapore that are more popular. So we talk about international HQ, which is the more popular one, the merger and acquisition, and the global trader program. And also double tax deduction for internationalization. This is also quite popular, gaining popularity. And there are changes for this in the budgets 2021. Eddie will bring you through more about this later on. Okay, so the next is I can see fund management incentives. These are gaining popularity. So this is a family office whereby the high net worth comes to Singapore and they start the investments, fund management activities here in Singapore, and they get very attractive tax. Okay, so I think I'm done. So I'll pass on to Eddie to just highlight on the budgets and the overview of the tax changes.
Okay, thank you, Boon Yip. Yeah. Okay, sorry, my name is Eddie, and I'm the tax director of MRI. I have about 30 years of experience. I'm actually an accredited tax advisor. I'm experienced in dealing with personal tax, corporate tax, and across the border tax planning, including international expatriation program we have. Of course, you know, if there's anything that you need to ask, we can do it at the Q&A later on. Coming to the budget for this year, which was actually done in February, I'll just give you a very short overview covering the important points of the 2021 budget. Actually, as you can see from the slides, the budget is actually meant as you know, the bulk of it is actually for support for workers and for businesses. I will use acronym. You can see those highlighted in orange is actually job support scheme. Later on, you see that there are also other aspect of it, which is actually also more like a subsidy from the government to the businesses to ensure that workers are continually employed during this difficult pandemic time. For example, this job support scheme actually is more towards funding the important areas of the industries, such as the aviation, the aerospace, and the tourism. That means the hotel, the airport, whereby even if you are out of job, even if you are not allowed to go back because of the pandemic, the government will continue to pay the businesses that are in this sector at least about 30% of the wages of the employees. Okay. Next, we go to wage credit scheme and the job growth. Now, these two schemes actually started very early. Wage credit scheme actually started way back in 2019, I think, and it is actually more towards trying to co-match incremental, encouraging companies to support workers by giving them increment every year, and whereby the government will actually fund maybe up to a team of 15% of whatever increase on a year-to-year basis. So that's the WCS, which is a wage credit scheme. The next one is actually more to incentivize hiring of locals, which is under the job growth incentive. We call it JGI, and that's actually to look at the companies in Singapore. If they hire local, then there's a chance that the government will actually do a matching of the co-payment of up to maybe 25%. So during this pandemic time. So continuing down, the other changes in the budget is actually more on to help the businesses to cope. We have various like the first one that we have is actually the carryback relief. Now we have carryback relief, which you allow a deduction for up to 100,000 for the immediate year. Now this extension is actually allowing it to be carried back 3 years, up to 3 years from the current year, right? That's the carryback relief. The next one is actually an accelerated capital expenditure, which is sort of a depreciation allowance whereby you can claim over a period of 3 years. Here the government saying, okay, you are allowed to claim it over 2 years, 75% on the first year, 25% on the second year. Okay, so that's actually more like to say, I will allow you more write-off so that you will pay lower tax, hopefully. Now, the third one is actually on what we call the R&I expenditure, which is for refurbishment and renovation. Usually, this is not a qualifying deduction, but they have set aside, say, look, we'll give you 300,000 over 3 years, whereby if you don't qualify, but it fits into one of those refurbishment or those renovation that expenses that is actually not part of non-qualifying items, which is for buildings and all this, you can claim a deduction against your taxable revenue. Okay. Okay, just now Boon Yip was explaining about the double deduction. Okay, it was actually in place for many years, basically to incentivize or to encourage businesses to expand overseas, do marketing, for example, to visit new places, to open up new market, or to sell new products in old market. So the current criteria, if you look at the slide, there are about 5. Now, what they want to do now is actually to say, hey, during this pandemic time, I think instead of going for the actual physical trade fairs and booth setting up exhibition, you are allowed to do virtual trade fairs, provided is approved. And then these are the costs that you may incur, and these are the costs that we will actually allow in addition to those that has been given before. So the value is about 150,000, which you are allowed to claim a double deduction. The deduction is actually automatic. There's no need to apply for approval from the relevant authorities unless you have actually spent above the cap of 150,000. And if you have any other new items that you think is not covered under the existing activities or expenses, you may even ask for a case-by-case approval. Okay. Now, the next one is actually more support for the what I call the non-business aspect, the charities and the non-profit organization, whereby there's an extension of incentive given, and this will actually be extended by a couple of years from where we have. It's supposed to be endings till end of the year, for example. And for example, in the case of the business and IPC partnership, BIBS, it will probably extend it to 2023, and the other one will be 2027. IA, which is an investment allowance granted to incentivize automation, productivity, and scaling up of machineries and effort. This has been scaled down. They actually decided to actually let it lapse. Okay. Okay. These two, I think I'll jump because actually it's more for environmental friendly expenditure, which will qualify for additional deduction. Okay. Okay, this is actually a change on some change on the services tax, which is actually a consumption tax in Singapore, which is now extended to what we call B2C business, whereby kicking in from January 2020, we have this overseas vendor scheme. We call it OVR, and as well as a reverse charge for the GST, whereby it's more a GST on the supply of goods and services coming from overseas by foreign suppliers. There's a need for GST registration. There's a need to see if you are liable for GST registration if you are one of those vendors from overseas under the scheme, which is the OVR scheme, or the reverse charge. Companies who have to examine themselves and see whether they fall into the criteria for compulsory GST registration under these two schemes. Okay. Let's go to the next one. Okay, low value goods is one item whereby nowadays we Singaporeans or those from Singapore likes to visit the neighboring countries, and then we bring back the goods. Now, what this change means is that in the past there's a green lane, there's a red lane. From now onwards, there will be no more green lane. Everything will be declarable. You have to declare for GST, which is to say that the low value goods, which there's an exemption criteria. I think it was $100 or $150, but you don't have to declare. There's a green lane you can go through. Now there's a need to declare and pay GST the moment you bring them in. Okay, the next one is actually B2C import. I think that will come very much later, whereby now if you are subscribing to say education for maybe for training or for seminar, whereby it is actually undertaken by a foreign person, so that will actually come under the GST regime, which is about the same as what is in place in Australia and in New Zealand. So this will not come in so immediately. It will start, I think, 2 years later. They are trying to look at how to set up a regime that is able to cope with and monitor this recovery of GST from this area. Okay. Okay. There's one new change to the which concerns GST on how to rate median advertising revenue, which is actually going to increase in the future. So we are looking at whether there's a possibility of doing zero rating on this kind of revenue, whereby it is online. So what happened now is that the government has actually said, look, we'll define the laws for you. If the customer belongs in Singapore, the media sales will be standard rated, that means subject to 7%. But if you are able to demonstrate that the services actually is actually for a customer overseas and actually is rendered overseas, then it can be zero rated. So this is actually to define where zero rating applies or standard rating will apply. And this kicks in from next year, January. Okay. Next. Okay. This is finance sector. I think I'll skip because it's more towards the bank, but withholding tax about double tax deduction again. Same too, I will skip on the withholding tax because it's financial sector, the banks as well. We'll skip this. Okay, so I think probably we end it. I think we'll have, we should allow more time for Derren and for us to do a Q&A. Thank you.
Thank you very much. Okay, so now we come to what I think is a fun part, the Q&A. Yeah. I'm gonna see some questions. For those who are watching us on Zoom, you can just type in the box below. There are more people watching us on Facebook. You can comment below, on LinkedIn, the same, and we'll get to them one by one. First question: what does a tax consultant need from clients to be able to help us file? You just need to reach out to any one of us, to Boon Yip, to Eddie, to myself, to Hannah. Just shoot us an email. Our emails have been given in the box below for those who are watching on other streaming platforms. You can email us at help, as in HELP, at htj.tax, help at htj.tax, and we'll start the conversation going and get you onboarded. Next question. Someone, I commented earlier that the IRS is really backed up and it's really messy, and a lot of 2019 has not been filed. There's someone who's watching who the 2019 apparently has not yet been filed. If it is there any questions around 2019, you can you'll probably need to reach out to the IRS directly, but bear in mind, it's especially this time of the year, it's going to be quite a long process. You need to email them. You can check for a contact number on their website, the number that I use, and I get through typically within an hour, depending on the time of the day. I try first thing in the morning, so like 8, 9 o'clock, or last thing at night, and I tend to get through within an hour. So that's 1-267-941-1000. That's 1-267-941-1000. And you can have a conversation, find out whether they did get it or whether you need to resubmit it. And yeah, I know a lot of people who paper filed, they're having problems. Moving down. Someone's asking about a template for 2020. Again, same responses above. You can email any one of us and we'll get you onboarded and we'll get you the organizer. According to the rules of the American Institute of CPAs, we're required by their rules to use an organizer. So we have a spreadsheet that has itemized all the questions that we need to ask to onboard clients. So we get that dialogue started once you email us. Also included, somebody's been asking about reaching out to Boon Yip and Eddie directly. Their emails, so you can do help at htj.tax if you've seen, if you're on one of the streaming platforms. If you're on Zoom, if you look down in the chat box below, Boon Yip's email is there as well as Eddie's email is there. You can reach out to them directly. Feel free, please do so. Next question. All right, I answered that one already. Going on. So yes, to the person who's asking about the presentation, yes, Boon Yip and Eddie did speak about businesses, but if you have any questions on individual Singapore, individual tax matters, feel free to just type in the box below. That's no problem. It will be anonymous. I won't say your name. Scrolling down. Did you say earlier that we need to report our CPF account balance? The answer is yes. The CPF is a qualified plan in Singapore, but it is not a qualified plan in the US, which means you need to report that you need to report the interest on your Schedule B. Depending on the threshold, you need to report it in Form 8938. And of course, you need to put it on your FBARs, the Foreign Bank Account Report. And sometimes for those of you who are using tax teams outside of Singapore, they don't know what a CPF is. So you probably just need to share that with them, that the CPF is a qualified Singapore plan, but it's not US qualified, so we need to report it accordingly. Next question. Brokerage accounts, shares. This is regarding a brokerage account. Shares invested. If I invest in a brokerage account and there's no income or dividend, do we still need to report that? The answer is yes, and this is where it gets interesting. If it is that you just buy shares in Singtel or whatever you like, that's one thing, right? If it is you hit the threshold, you report that in 8938 and interest on Schedule B, dividends are in Schedule B. But if it is you invest in a brokerage account, and really popular in Singapore would be like iFast, or some of the other financial advisors sell you insurance policies, or they sell you pension plans. Now, you need to be particularly careful with those, because under US tax rules, some of those insurance policies, especially those with a cash surrender value, are actually investment products. And they're treated as something called a PFIC, a passive foreign investment company, which is the bane of your existence if you're a US taxpayer. That is what you hate the most. Because why? Because it has to be taxed and treated according to special rules that were passed in the 1980s. And it's taxed in a almost draconian fashion. So if it is that you have an investment in any sort of brokerage account, so it's any sort of mutual fund, any sort of unit trust, or pensions or insurance policies outside of the US, run them by your preferred advisor. Make sure that you don't run afoul of the PFIC rules. The PFIC rules are the ones that you want to avoid like a plague. Scrolling down. If you have your own business in Singapore, you would still need to file in the US. You're absolutely correct. Your business is reportable in Form 5471. And it may also, any investments in the business, you report that in Form 926. And the profits of the are also reportable on your personal tax return. Depending on your situation, depending on whether there's a control, whether your share or the share of all the US persons combined exceeds 50%, then there's special tax rules that kick in. But the bottom line is yes, have business in Singapore, must report to the IRS. Someone is asking for the IRS number again, the number that I use to get through within an hour. Again, first thing in the morning, US time, last thing at night, US time. 1-267-941-1000. That's 1-267-941-1000. Even if I make no income in the US, are we still eligible for stimulus payment? The answer is absolutely correct. Yes, you are. If you go to the IRS website and you type in the search box like stimulus payment, and you get all the FAQs, and there are a lot of tools that allow you to interact and to register. Because of course, getting through to the IRS on the phone is like really hard right now. So if you have not got it, you can input your details into the IRS website. Yes, you are eligible for the stimulus payment. And you don't want to miss out on the third one, the one that was just announced or decided by Congress or signed up by President Biden over the weekend, because that is pretty attractive. Next question. Can we live in the US and have a Singapore company? Yes, you can. Freest country in the world. You can live in the US and you can have a country anywhere in the world, except if it's a jurisdiction that is subject to sanctions. So not Venezuela, not Iran, not North Korea. But yeah, you can live in the US and have a company outside of the US. But remember, in that scenario, that you are actually running the company from the US. So you need to speak to your advisor, because special tax rules may apply if you're running it, if you're the key decision makers and you're based in the US, as opposed to you have boots on the ground in Singapore and you have a CEO, you have a team that's running it in Singapore. So you'd speak to your advisor about the nuances of that. Next question. I'm sure it varies state by state, but what are some of the things necessary to do in order to sever ties with US states, particularly where we potentially owe state tax if we move back? That's a great question. And within your question is the answer. It does vary state by state, but you want to pay special attention, especially those who may be domiciled in California, because of course, there's now a discussion going on around wealth taxes, and you don't want to be caught in that net. because that is double taxation to the highest level. But essentially what it involves, and again, it varies state by state, but what you'll be doing is sitting with your advisor and you're looking at one of the 9 states where there are no taxes. Most popular will be Texas and Florida, obviously. And you make sure that, you know, your whole mail address, if you want a US PO box, is going to be there. If if you're going to register to vote, maybe you want to put it in one of those states. You know, the address for your brokerage accounts, everything, you're going to put it in one of those 9 states. So in other words, you give up your driver's license as well. Try and get it in one of. So in other words, you don't want to have any ties to the other states, the states that are pretty sticky. And to us, the stickiest state is actually Virginia. And for some of you who may be with, not with the US base, but with civilian contractors, maybe you don't have a choice, you're stuck to Virginia, but you still speak to your advisors for those who are civilian contractors. See if you can cut ties with Virginia if possible, and make sure and re-domicile yourself in another state. Next question, what if I haven't reported the CPF in the past years? I'll report it this year, would I be in trouble? If it is that your previous tax returns have been incomplete, there are ways of getting up to speed with addressing that. The most popular of which is something called the streamlined compliance procedure. And you Google that, you'll see a lot of stuff online. So basically the IRS says, okay, I know you haven't done whatever in the past, just the statute of limitation for your tax returns are 3 years. And for the FBARs, the foreign bank account reports, are 6 years. So in other words, come to me with the amended tax returns for the last 3 years, which due date has already passed. In that case, you're talking about 19, 18, and 17. And the last 6 years for FBARs, so 19 move back 6 years. And report your CPF on that, or report whatever the missing bank account or the brokerage account or whatever on that. And the IRS agrees that, and you have to pen a letter as well explaining the reason for your non-compliance. Depending on the sophistication or the complexity of your situation, because we've had clients obviously with more sophisticated structures and higher missing balances than others, then we work with attorneys in Singapore to help you draft the non-willful letter. So we work with Butler Snow and Withers Carter Wong, which are, as far as I'm aware, the only, I mean, there's Baker McKenzie and stuff like that, and DLR Piper. But in terms of working with individuals, US exposed individual private client work, you're looking at Withers Carter Wong and Butler Snow. We work with them closely to make sure that you get the non-willful letter done in the right way to prevent any issues. But you're looking at streamline if you need to catch up. Some people, especially online, if the keyboard warriors, they're going to be Googling, and some people would advocate quiet disclosure. Read the fine print, see whether those people are US qualified. Chances are they are not. They don't have a CPA license on the line. They're not an enroll agent. They're not an attorney. They're just, you know, a helpful keyboard warrior in one of the, especially one of the Facebook groups. We strongly advise against quiet disclosures. If it is, you made a mistake in the past, we all make mistakes. You need to disclose it in the right way. Moving down. What is the approximate price range for helping us file US individual? Federal returns start at 800 Sing, state returns 400 Sing, FBAR start at 400 Sing. If it is that you have a company, depending on the complexity of your Singapore entity, because we actually have to translate from Singapore GAAP, generally accepted accounting principles here in Singapore, to US principles to report it to the IRS. And we charge 1,500 or 2,000 for those. So that's a rough price range, but please feel free to reach out to Boon Yip or Eddie or Hannah or myself, and we can get you up to speed, get you an accurate quote. Next question. Thanks for the blah, blah, blah. Question, will a non-US citizen spouse retirement investments in IRA or Roth filing together with a US citizen be at risk of higher tax rates in the future if their green card is forfeited? Now, this is something I actually have a client that I emailed like 10 minutes before this. They're in a similar situation. Okay. a US retirement account is a US tax preferred. It's a tax preferred account. It's meant for US taxpayers because the benefit of having a 401k or a Roth or whatever is tax deferral to some extent, depending on what it is. If it is you cease to be a US person because you have renounced your citizenship or you have given up your green card, then in theory you should be speaking to your broker back in the US and letting them know that you are no longer a US person, and they will work with you accordingly. Chances are you'll need to transfer the funds from the retirement account into another. So if it is that you were a US person, you invested and you built up a retirement account, and now you are no longer a US person, you should reach out to your broker back in the US because you may no longer qualify. And it's not just retirement accounts only. People just have investment accounts on US platforms like Charles Schwab, for example. Even if you're still a US citizen, you're still a green card holder, you're living in Singapore, they don't like the fact that you're living in Singapore. And it's not, they say it's against the rules. I don't think it is. It has nothing to do with SEC rules. It has to do with the compliance burden. If it is that they have clients that reside outside of the US, they face an additional compliance burden. So and that means an additional cost basically. And so it costs way more to service your account than it does someone who's based in the US in terms of the extra paperwork. So even, I know some people come back and say, well, I use a VPN. Some of their platforms are so sophisticated, they can tell that you're signing in with a VPN, and they give you a certain number of chances and they freeze your account. So reach out to them before they figure stuff out so you can just work it through. They just don't like account holders outside of the US. So please speak to your broker. Next question. How many years do you have to pay taxes to the US after you give up US citizenship? Yeah, I know this is a big decision for many people. We deal with 2 or 3 clients each month who are giving up their US passport or green card. They're under the old rules. Yes, you had to file returns for a certain number of years. Under the new rules, the rules that are in play right now, unless you have some sort of deferred tax liability, typically you don't have to continue filing tax returns after you've surrendered your green card or passport. If it is your covered expat, and what I mean by a covered expat, covered expatriation. Expatriation refers to the process, the legal process of giving up your green card or US passport. And you're covered expat if your net worth is higher than a threshold, 2 million, or your tax liabilities for the preceding 3 years are more than, let's say, 150K or so. So if it is that you are a covered expat, special rules apply and some pre-expatriation planning may be necessary because you'll be facing an exit tax. So if it is that you are a high net worth individual and you're considering surrendering your passport or your green card, please reach out for professional advice because you want to mitigate as much as legally possible the exit tax. But typically, if it's just like a regular person who's not a covered expat, there's no deferred tax liability and you're giving up your passport or green card, there's no requirement to file returns after you're done unless you have US source income, typically rental properties and stuff like that. Next question. If I own real estate, this is the last question because we're approaching the top of the hour. If I own real estate in Florida, but I'm not living in the US, I live in Europe, am I still considered a US resident? Do I have to pay taxes in the US? It depends. If it is that you remember we referred to section 7701 previously. If you're not a US citizen, you don't have a passport, you don't have a green card, you didn't hit substantial presence, then no, you're not going to be taxed on your worldwide income once you're outside. If it is that you did hit substantial presence, you do have a green card, you do have a US passport, you're subject to taxes on your worldwide income. If you're not caught up because of Section 7701. You're not a U.S. taxpayer, and all you have is a rental in Florida. It's okay. You just pay federal taxes on whatever the net income is. Normally, we work with our real estate clients. We make this an election because the default is that it's subject to 30% withholding, right? Your rental income. So we make an ECI election. We make an election for the rent to be treated as if effectively connected income. So therefore, you get to deduct the expenses that are ordinary and necessary to run your real estate investment portfolio. And you only pay taxes on the net income. So speak to any one of your chosen qualified advisors if you have a US real estate portfolio. And with that, thank you very much. We really appreciate your time. Those on the various streaming platforms, thanks for logging in. Please feel free to reach out to Boon Yip, to Eddie, to Hannah, to myself. Thank you very much. Have a good evening, guys. Bye-bye now.
Here are 4 ways we can help you. Number 1. Sign up for free webinars on US expat taxes and international entrepreneur taxes at www.htj.tax. Number 2. Stream premium educational videos at www.htj.tax. Number 3. Contact us for tax optimization consult over Zoom. Number 4. High net worth. We can quote for doing your US international taxes returns. Our books and upcoming event are available at htj.tax. Please subscribe, like, share, and comment below. Email us at help@htj.tax to engage us, to advise on international tax or business matters.